some red flags will camp here very briefly because it does tie into the diversification thing, third-party custodian. So if I go to Glen James as a financial advisor, I'm not saying, hi, I'm Glen James, I'm your financial advisor. By the way, we want you to set up a self-managed super fund and we're going to put the lion's share of your money into the Glen James investment fund, and I personally select the best investments within that. And
that was a big problem 15, 20 years ago, where you had most advisors were licensed through what were called vertically integrated businesses, where they had an advice business, they had a funds management business, they had an insurance business, they had a superannuation product, and you were very likely to get recommended in-house products. That's becoming much less of an issue, but certainly if you're getting in-house product, you should be asking questions. That's not to say that all in-house product is bad, but you do need to be aware of it. And most losses have occurred where there's a concentration of ownership of that product. So most times where you see a failure of a product, it's largely associated with the relationships around that sale product. So, so at LifeShopper we use all of the big fund managers, largely index managers, so Vanguard, BlackRock, State Street, all very reputable brand names, none of whom we're related to. And assets are generally held by a third-party custodian.
Question. I think a red flag is potentially when they hero returns.
Yes.
And we can beat X, Y, Z.
That's right.
Now, there could be by the way, factually speaking, what we've recommended here, if we back tested it across Australian Super, it is actually 1.5% more.
Yep.
Another trick, make sure they're comparing the same asset allocation.
Yes. That's
not saying, our fund did better, because it's higher risk.
Yes.
So
that's
we're not interested in someone putting pressure on, heroing that we will get you 13% a year guaranteed. We don't like the G word.
That's right. And, that's a natural human thing, though. So humans naturally want to be able to make more money with less risk. So if you hear that message, it's an attractive message.
Yeah.
But it's also unrealistic. That's not how the real world works. That if you want more return, you generally have to take more risk. And so there is a need for skepticism. So if someone's saying, I can get you X%, especially if it's followed by the word guaranteed or certain, then, and it's, if you want a guarantee, it's pretty hard to get more than the cash rate. So if someone's guaranteeing you more than 5, there's a flaw somewhere. But it is a natural human reaction to go, I want more for less. And that's not how the world works.
And here's another red flag, everyone. When you're going to a financial advisor or a property coach, you can go to John Pigeon, who hosts our property show, and get coached of how to buy an investment property to build wealth for the future, right? All legal, all good. From your own personality thing, don't go to a professional with their solution to make all your problems disappear and catch up the 15 years where I haven't put money into super.
That's right.
Because that's when greed can walk in the door. Yeah. And that's when something that follows greed is stupidity. Then after stupidity is broke.
That's a good one, yeah. I mean, people often, when they think about getting an advisor, they think about, is this advisor going to beat the market? And that's completely the wrong question to be asking. And what I will quite clearly say, and you've probably heard me say this on this podcast many times, that the market delivers the returns. My job as your advisor is to make sure it ends up in your pocket. And the reasons it won't end up in your pocket is that you've got an asset allocation that doesn't align with your risk, and if you run the risk of hitting the sell button inappropriately, you pay too much taxes, you pay too much fees, or your behaviour gets in the way. And all of those things are what an advisor is doing for you. So when I recommend that you put 20% in Australian equities and that you should buy the Vanguard Australian Share Fund, well, VAS doesn't know whether I recommended it or your cat picked it out by pissing on the newspaper. It will do what it does, and it will do what the Australian market does, because that's what it's designed to do.
Yeah, as a general rule, and for my life, I'm okay with market returns.
Yeah, but I think that the thing about market returns, though, and where you do get...
They always perform less than the market after fees.
that it's the blend that creates the plus. So whilst VAS doesn't know whether I recommend it or you chose it, or you threw a dart at the wall, the way it works with the small cap Australian fund that we put with it and the US investment and the global and the emerging markets and the real estate and the infrastructure and the gold and the bonds, that's where the excess return comes from. And that takes years of experience to do. And it's not just about lining up the ETFs and going, which one gave me the best return?
Yeah, and we don't, when we're investing, we don't look at the the magazines with here's the best funds the last month or the last year to date. We don't care what the last year did, and we're not making an investment decision based on the previous returns. Yep. I will say, we've got to round this out, Vince. We've talked about the diversification or lack of returns. We're not heroing them or shatting on other funds. Low fee doesn't equal best.
Correct. And often low fee is a function of asset allocation. So large cap equity, so that's large companies. So in Australia, the Vanguard Australian Share Fund is 0.04.
Yeah, 0.04.
But it's close to zero.
They call that free.
Yeah, it is vanishing close to zero. An S&P 500 US large cap fund should be that same sort of number. But that doesn't mean that you should just buy Australian large companies and US large companies because they're cheap. You actually need some infrastructure and some real estate, and they might cost you 0.5 because they're just more expensive to manage. But the mix of those four things will give you a better answer. So you've got to... Price only matters when you're getting what you need. And by eliminating the expensive stuff, you're lowering the price, but you're not getting what you need. And so there is a balance. Now, fees matter. They matter a lot. But they only matter when you're getting what you need. And by saying large cap equities are cheaper, therefore that's what I should invest in, is just a nonsense.
And just on that, Vince, there was a popular book, Barefoot Investor.
Second best-selling book in Australia after the Bible.
After the Bible. There was, I don't know if I'll use the word recommendation, but there was a vibe to move your super
I think I'd call it a recommendation. Okay. He did have a license at the time, so it's probably okay.
Move your super to the Host Plus index balanced option because it's the cheapest super fund in Australia.
And it still is.
If we look from now in July 2025, that fund did 7.31%. Pretty good.
On average. For 10 years.
10 years.
Yep.
Now, if you went to the balanced fund that is more expensive, which, old mate was like, go to the cheapest fund in Australia because fees obviously matter. Yes and amen, fees matter. The balanced fund, after fees and taxes, did 7.94%. That's 0.63%, 0.5% higher performance than the cheaper one. So if I paid more, I would have got a higher return, probably a smoother ride.
Yep.
It's
Almost certainly lower volatility.
So I'm 150,000% not shatting on that book, not shatting on him. I'm pointing out fact that if you purchase the cheapest investment option, you are financially worse off over the last 10 years.
Although the interesting thing about that anecdote that you just told is that if you talk to Host Plus, so Sam Cecilia is the face of Host Plus, he will tell you, and in fact he told the Royal Commission this, so I'm not telling anything out of school, that that book resulted in huge inflows for Host Plus.
I went into the wrong return.
But they actually the vast bulk of it went into the balanced fund, which is the better asset.
Yeah.
So by dumb luck or marketing on the part of Host Plus.
But that also is a really good example to speaking to the need of financial advice. Like you read a book, listen to a podcast, I'll go and do it myself, and I'll do it myself and I stuff it.
Yeah. Now that stuffing gave you the better answer on that occasion.
On that occasion.
But it's just as likely to work against you.
And I think the crescendo that I want to finish on, there's a lot of there's an individual that's spending a lot of money on Facebook ads at the moment and, you know, very anti-bank and paying off your mortgage fast and all this stuff. And I think you were telling me that you went to or you had a member do one of their online seminars. And
yes, so one of our members that we did some financial advice for around their super about 6 months ago, it was cold called.
From the same individual's company?
I think so. I don't know, so I'm not going to say. But they got cold called and got talked into buying an off-the-plan property in Melbourne and set up a self-managed super fund.
Was it an apartment by chance?
It was a high-rise apartment off the plan. And so that would have resulted in a project marketing fee of potentially...
That's a 30 grand deal for that company.
Or more. They would set up a self-managed super fund. And so the first we knew about it was we got the rollover request, which obviously we checked from a rollover request to a self-managed super fund. You go, high risk, let's call the person and go. And so she told me that that's how she done it. She was happy with the decision. But
I'm sure she was.
Today.
She was going to make lots of money.
But the proof of that pudding is in.
So what the individual has done has been sold the dream that we can get you a better return and you can have a property. But in one strike of the pen, they're less diversified, higher risk, more complexity, and what could go wrong?
What could possibly go wrong?
So for me, if there's a push for a self-managed super fund, and
that's a bit of a red flag.
That is the biggest red flag on the planet, unless there are some very complex estate planning issues. There could be significant balances. There could be a commercial property for a business, like all that stuff. But for the main, so if we swing it back around full circle, the question at Angela, if she went to an advisor and said, we've got this self-managed super fund, commercial property, we need some advice, there would want to be a reason that would literally explode my mind as to why the self-managed super fund should be kept open. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.